Yo, what's up guys? Welcome back to a brand new video. Now today I'm going to be making a video on how you can make like $500 to $1,000 weekly, and it's the safest strategy. It has to do with options, so if you want to get into options, do this instead of the normal calls and puts, and let's get into this video. Let's go. Alright guys, so before this video starts, I just want to say I'm not a financial advisor, so whatever you do, whatever you buy and sell is at your own risk. And also, make sure to leave a like and subscribe to the channel because I post daily stock picks and the best like penny stocks, the best stocks to buy, and they always usually run up after I make the video. So leave a like and subscribe to stay tuned to all of these great videos. Also, I'm looking a little bit like a drug cartel member. Yes, I have a stash now. And yeah, that's besides the point, but let's get into the video. Alright, so there's two strategies here that I want to talk about. Now, the first strategy, or like that's before we talk about the strategy, let's talk about just quickly how people trade options. So they go to, like, let's just use Apple as an example. They go to trade options and they just buy calls, and then they lose all their money because calls and puts are terrible. Unless you really know what you're doing, and even then it's kind of just lucky because intraday this moves randomly. Like, let's just take a look at Apple again. Like, let's take a look at Apple. Look at this. Like, when do you know how to enter here? Like, if you want to buy a call, and you wanted to buy a call on Friday, because I'm recording this Sunday. If you wanted to buy a call Friday when the market was open, when exactly would you buy a call here? Throughout the whole day you would be losing. So, you know, like, that's what I'm saying. Like, calls and puts are very risky. So let's talk about the other things that you could do to make like 500 easily, like a week, maybe even 1,000, depending on how much capital you have. Let's start with number one, and it is selling calls, selling covered calls. So let's say you have 100 shares of Apple, right? Costs you $13,179. So it costs you $13,000, and now you hold these for a long time. You're planning to hold Apple forever, like until you die. So let's go to trade Apple options. Well, one thing you could do here is selling a covered call. So all you have to do is pick a strike price above the share price right here. So if you think by February 5th, so when the market opens, that's like 5 days. In 5 days from February 1 to February 5 days. Let's go back to Apple here really quickly. You don't think, let's select the strike price of $135. Before the 5th, Apple cannot pass $135. And let's talk about this. If Apple does not, let's go to sell call again. If Apple does not pass $135, then you get $233 at the end of the week. So that's yours. That's yours to keep, and you could just recycle and do it again and again and again. So let's say it's February 6th now. Now you go to the February 12th one, and now you sell these. 135 again, if it's still like around that area. If it moves up to higher, so let's say Apple's trading at 135 now, then you do the 141. And you just keep doing that, and you just collect premium on top of the already 100 shares of money that you're gaining. So yeah, this is perfect if you already have a lot of positions. Like, if you already have a lot of positions right now on shares, I recommend you go to the option chains and you start selling covered calls, because that's extra income that you're getting for doing nothing at all. So you're just holding 100 shares of any company, and you're making extra money in premium at the end of the week. Why? How is that a bad idea? That's a great idea. So yeah, this is extra income. So now let's say what happens when, if you select the $135 sell call option and it reaches on February 5th, it's at 136 and the day closes at $136. Well, you lose the 100 shares, but you still get the money from the premium. So yeah, realistically, the worst that can happen when you sell a call is that the call's gone, and then you lose your 100 shares, but you still get to keep the premium money. So obviously, I recommend selecting a price where it's not gonna reach in 5 days. That way, you still have your 100 shares, and you still get the premium money every weekly, rinse and repeat. Now, one risk here is that you obviously want to have a good stock that you like holding 100 shares of. Because either way, you're gonna need 100 shares of them. Like, you're gonna need 100 shares of them to do a covered call. So pick a good stock that you don't mind holding 100 shares of. Also, another thing here, pretty much, let's use SNDL as an example. I have my small Robinhood account that I just deposited 100 so I could put it into Dogecoin quickly, just random lotto. Let's do a small company, for example. Like, if you have like 10K in your account, then you could put it all into this company. That's huge risk, by the way. But let's just say you do, and you have like 8,000 or 10,000 shares at $8,000. So now you go to trade S&DL options, you sell a call, and you select a $1 strike price. You don't think it's gonna get to $1, but even if it does, that's good because you have 8,000 or 10,000 shares. You go here, you type continue, and you type 1,000 contracts, actually 100 contracts because you have 10,000 shares. You put your limit price to 20 cents, whatever. That's a $2,000 credit that you get paid at the end of the week just for owning 10,000 shares of this company. So find a solid company. The cheaper the better because you could put more contracts and you can get more premium weekly that you don't mind holding. That's a good long-term growth, and just hold it and make income for literally just holding 100 shares. That's the strategy. That's good. And now the other strategy is that you don't need to have 100 shares of a stock, is actually selling puts. Let's go back to Apple. Now you go to trade options. Now instead of selling calls, you sell a put. You sell a freaking put. Now the basis of this one, pretty much the structure is that you buy share price, you buy what's under the share price, because you don't want, basically you don't want the stock to expire below whatever strike price you put. So let's say 130, Apple's trading at 131. In 5 days at February 5th, I do not want it to be under 130, and I get to keep $286 premium. Whatever it costs for the contract, that's how much you're gonna get at the end of the week. So yeah, if you don't ever want to hold shares of an actual company, so you sell covered calls, then you sell a put. You don't need to hold any shares, but there's always a but. This is very risky because let's say you buy the 130 strike price and Apple plummets to 125. So now you are forced to buy 100 shares at $130 and Apple's trading at 125. So you're automatically losing money right there. So guys, be careful. I just want to explain this very, very through and clear to you guys so you guys don't lose money here. If at the end of the week it expires under the strike price you bought it for, you have to exercise those shares and you have to buy them. I don't think any broker, I'm not sure, will let you buy unless you have the amount of money and buying power available to cover just in case it happens. So Apple's trading at 131, so you need $13,000 in your account just in case it forces you to buy at $130. So that's the only real risk. So you think of selling puts as a safer way to buy a call. So if you want to buy a call, you think the stock's going to go up. But if you want to sell a put, then you also think the stock's going to go up because you don't want it to go under your strike price. So let's say Apple's trading at 131 right here and your strike price is right here. You want it to skyrocket so it doesn't ever reach this area. So you're seeing it as a bullish position. And that's pretty much the way these two things go. Selling covered calls and selling puts. I kind of like the selling covered calls more because if you're an investor and you just want to hold shares, and it's a great way to just get income weekly without really risking much and doing anything. All you have to do in sell calls is get a far strike price and make that weekly without any risk. And yeah guys, that's pretty much gonna wrap it up. That's pretty much the two strats I wanted to talk about. Hopefully I explained it very clear to you guys because it's very simple to understand and it's much less riskier, way less riskier than buying your standard call and puts. Because I think options, unless you really know what you're doing and you have years and years of experience, it is not safe and it is not consistent. But this is consistent. And yeah guys, hopefully you enjoyed the video. Hopefully you learned here something. Thank you guys for watching this video. If you want more videos like this and more stock picks, penny stocks, etc., a lot of picks for you guys to make money, just subscribe to the channel and leave a like on this video. It will help out so much. Thank you guys for watching. I'll see you guys in another video. Peace.